I'm sure you're excited to learn how to have a 50% return every year. Just how did Warren Buffett do it? In a Business Week interview in 1999, Warren Buffett said that he can guarantee that he could make a 50% return a year if he only managed $1 million. He stated that if he was running $1 million today, or even 10 million for that matter, he'd be fully invested and guarantees that he could make a 50% a year on $1 million. Warren Buffett today controls far more than a million, if not $10 million. Therefore, what he said in 1999 no longer holds true. Berkshire Hathaway's net value is 796.24 billion US dollars as of November 17, 2021. Buffett, on the other hand, believes he can get a 50% return on $1 million if he manages it properly. To accomplish this, Buffett would employ a variety of tactics. That's what I'll be demonstrating in this video today.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Strategy number 1: only companies from well-regulated countries should be considered. You must ensure that the companies in which you want to invest in are located in nations with second business practices and a well-regulated market. When it comes to a small enterprise, you need to ensure that the data and figures they're disclosing are reliable. Warren Buffett is a huge fan of American stocks. Companies in the United States are well known for their reliability and trustworthiness around the world. The U.S. Securities and Exchange Commission, as well as other financial organizations, closely oversee the stock market in the U.S. They check the veracity of figures published by public firms on a regular basis. As Buffett would say, the United States is the ideal place to invest in small-cap stocks. Other established countries like Canada, UK, and Australia are fine as well, as their security regulation is up to pace and their commercial practices are dependable. His favorite, though, will remain as the United States. Investing in small enterprises in third world countries or countries that are new to the stock market should be avoided. The same way be said for countries with dubious business practices and poorly regulated industries. We do not advise investing in Chinese companies since the data they publish are untrustworthy. If you have any doubts, ask competent persons you know who live in China or other small third world countries. We honestly believe that investing in these is not worth the risk. Strategy number 2: purchase at a discount to the intrinsic value. Small cap stocks are particularly easy to accomplish this with because they are frequently underanalyzed. As a result, there will be several opportunities to purchase such a stock at a significant discount to its true value. Perhaps you're unsure of what intrinsic value is. Well, it's actually the stock's genuine value, or what it's actually worth. It differs from the present stock price, which fluctuates with the stock market fluctuations. Learn how to determine a stock's intrinsic value so you can assess if a small cap stock is trading at a discount to its inherent value. If that's the case, now is an excellent time to invest. You'll have a better chance of making a lot of money. But now I can practically hear you remark, "Wow, that's good to know, but how can I figure out what stock's intrinsic value is?" Well, there are a few options here. The simplest method is asset-based valuation, which involves subtracting a company's total liabilities from its total assets to arrive at its intrinsic value. Now, however, the disadvantage of this strategy is that it doesn't account for company development. Hence, it frequently yields lower intrinsic values than more complex procedures like discounted cash flow research and financial metric PE ratio analysis. The good news is that the intrinsic value of the stock remains pretty stable. So the key is to buy when the stock is underpriced because you'll then have a higher return. It's simple math. If you pay $10 for a stock that earns $1 a year, then that's a 10% return. But if you buy the stock well below $10, like for $2, then the $1 a year earnings is now a 50% return. The good news is that the stock's intrinsic value has remained relatively steady. The goal is to buy when the stock is undervalued, as this will result in a bigger return. Strategy number 3: begin investing in small companies. What is a small cap stock? It's a publicly traded business with a market capitalization ranging from 300 million to 2 billion. Because he manages billions of dollars, Warren Buffett no longer pays attention to tiny businesses. Buffett manages hundreds of billions of dollars, so even if he made $500,000 on $1 million investment in a lesser company, it wouldn't make much of a difference. However, if he had only $1 million, he would invest in small cap companies, and a 50% return of $500K would make a significant difference in his portfolio. In this instance, how might Warren Buffett obtain such a huge return? Well, let's take it from the source. He says you should look at everything and hunt for little securities in your area of expertise, where you can understand the business and occasionally find little arbitrage possibilities or market wrinkles. When working with a modest amount of money, there is a chance to earn a lot of money. Buffett is basically saying that you need to know what your area of expertise is. After that, once you've decided on an industry, make a commitment to become an expert in that subject. Look at the small cap stocks in your selected industry. Chances are you'll find amazing hidden possibilities here and there to generate huge returns, such as arbitrage scenarios. Strategy number 4, continue reading and analyzing. Those that put forth the most effort to read and research the most stocks are the most successful investors. One of the most successful investors in history, Peter Lynch, consistently stressed the importance of knowing what you possess. You'll need to do a lot of reading, studying, analyzing to accomplish this. If you look at 10 firms, you'll find one that's intriguing. If you look at 20, you'll find 2. If 100, you'll find 10. He remarked in an interview with Frontline. The player who rolls over the most rocks is the winner of the game, and that has always been his attitude. In general, your returns will be higher if you look at more firms, read more shareholder reports, and improve your investment knowledge. All of the reading was well worth it. In fact, when asked how to prepare for a career in investing in a Columbia Business School seminar, Buffett said, "Read 500 pages like this every day," alluding to his manuals. Strategy number 5, don't just go with the flow. Another approach to thinking about when it comes to investing is to remember one of Warren Buffett's famous quotes: "Be fearful when others are greedy and be greedy when others are fearful." Many investors, as I indicated earlier in this video, let their emotions to guide their investment decisions. An excellent example is when the Facebook stock dropped 40% in November 2018 owing to multiple scandals and occurrences that scared investors. Many people panicked and began unloading their Facebook shares when it was actually the perfect opportunity to invest in Facebook because the price had dropped so low. Because everyone was afraid and frightened, it was the perfect opportunity for savvy investors to get greedy. The fundamentals of Facebook were still solid if you look past the stock price. Their user base was rising and their business was expanding. They had a slew of new ideas up their sleeve. Those that profited from the stock market's decline in 2018 did so by not blindly following what everyone else was doing. Always keep in mind that investing is a long-term commitment. Markets will rise and markets will fall. But if you've done your study and know and understand the industry in which you're investing in, you'll be able to make informed investment decisions based on facts rather than emotions. And there you have it. These are the 5 strategies that you can use to have a high return based on Warren Buffett's advice.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.